Welcome to our deep dive on deploying significant savings across three popular paths: fixed deposits, mutual funds, and real estate. We will explore how each option maps to safety, growth, or leverage, and why over-prioritizing liquidity can stall your wealth. First, I will set the agenda, then share a quick disclaimer, and after that we will evaluate each option before building a diversified plan. Finally, we will test your understanding with quick quizzes and wrap up with key takeaways. Here is our plan for today. We will begin with the mindset trap around liquidity, then compare fixed deposits, mutual funds, and real estate. Next, we will build a decision framework, walk through a sample allocation, and finish with an actionable 5-step plan. Along the way, we will include a couple of short quizzes to reinforce learning. Now, before we get into the content, let's cover a brief but important disclaimer. This content is for educational purposes only and should not be considered financial advice. Your situation, risk tolerance, tax bracket, and goals are unique. Please consult a qualified professional before making investment decisions. With that important note covered, let's move on and discuss the common mindset that often leads to stalled financial growth. Many people over-prioritize liquidity because it feels safe. However, keeping excessive funds in low-yield instruments tends to underperform inflation, gradually eroding purchasing power. The goal is not to eliminate liquidity, but to right-size it. With that context, let's start evaluating the first option: fixed deposits. Fixed deposits offer capital safety and ready liquidity, making them ideal for short-term needs and emergency funds. However, the interest rates often fail to keep pace with inflation. Over long horizons, this leads to a steady erosion in purchasing power. Consequently, FDs are best used as a refuge for near-term needs rather than as the core engine for long-term wealth. Next, let's discuss what typically powers real long-term growth: mutual funds. To beat inflation and build real wealth, exposure to market-linked instruments is essential. Equity mutual funds have historically offered higher returns over long periods. The trade-off is short-term volatility, which requires patience and discipline, typically a 5 to 10-year commitment or more. Diversification through index funds or thoughtfully selected active funds helps manage risk. Before we move to real estate, let's pause for a quick knowledge check. Question: which instrument is generally best suited to beat inflation over 5 to 10 plus years? Options are A. Fixed deposits, B. Equity mutual funds, C. High leverage real estate, and D. Idle cash savings. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Equity mutual funds. Over long horizons, equity exposure has historically outpaced inflation, provided you remain invested through market cycles. Now that we have covered deposits and mutual funds, let's move to the third path: real estate and its leverage paradox. Real estate often relies on leverage, which magnifies both gains and losses. Taking on a very large mortgage can create significant job security pressure, especially for a sole income provider. Real estate is also illiquid, incurs maintenance expenses, and involves meaningful transaction costs. It can be beneficial when leverage is conservative, cash flows are robust, and income is stable. With all three options outlined, let's compare trade-offs between safety-first and growth-first approaches. On the left, a safety-first approach emphasizes fixed deposits or liquid debt. It offers minimal volatility and high liquidity, but typically yields lower returns, risking long-term purchasing power erosion. On the right, a growth-first approach uses diversified equity mutual funds. This path targets higher long-term returns, but requires willingness to endure short-term volatility. The choice depends on your time horizon, risk tolerance, and the size of your emergency buffer. Next, let's quantify these differences in a quick snapshot table. This table summarizes three asset classes across key dimensions: liquidity, expected long-term returns, inflation risk, leverage, and costs. Fixed deposits and liquid debt are highly liquid, with low to moderate returns and no leverage, but they face significant inflation risk over long periods. Equity mutual funds have moderate liquidity, moderate to high expected returns, low long-run inflation risk, and no leverage, with low to moderate costs. Real estate is typically illiquid, has location-dependent returns, variable inflation protection, high leverage if financed, and higher ongoing and transaction costs. Now let's walk through a simple decision-making flowchart to guide allocation choices. This flowchart begins with defining your goal and investment horizon. If funds are needed within 3 years, keep them in fixed deposits or liquid debt funds. If the horizon is longer, assess your comfort with volatility. If comfortable, favor equity mutual funds for 5 to 10 years or more. If not, consider a blend of debt and balanced funds. In parallel, if you are considering property, check that your debt-to-income ratio is at or below about 30%, and that you can maintain a 12-month emergency fund before proceeding. With the framework in place, let's convert it into a practical 5-step plan. First, define your goals and timelines, distinguishing short-term needs from long-term objectives. Second, establish an emergency fund covering 6 to 12 months of expenses in fixed deposits or liquid debt. Third, construct your growth engine with diversified equity mutual funds, using systematic investments or planned lump sums. Fourth, only consider real estate when leverage is modest and your income is reliably stable. Fifth, review your portfolio annually, rebalance to target allocations, and consider topping up during market corrections. Next, let's visualize a sample allocation. This illustrative pie chart shows a simple split: 20% in emergency and short-term reserves, 70% in diversified equity mutual funds for growth, and 10% reserved for property or alternatives if leverage is prudent. This is not a recommendation. It is a visualization to show how safety, growth, and optional leverage can coexist. To further align assets with time horizons, let's look at a quick timeline. This timeline maps instruments to time buckets. For 0 to 6 months, hold an emergency fund in fixed deposits or liquid debt. For 1 to 3 years, keep short-term goals in debt or ultra-short funds. For 5 to 10 years and beyond, allocate to equity mutual funds for growth. Only add real estate when leverage is manageable. Segregating funds by time horizon helps reduce sequence of returns risk and prevents forced selling during market stress. Before we wrap up, here's one more quick quiz to reinforce the leverage concept. Question: what is the biggest risk of high leverage real estate for a sole income provider? Options are A, lower property taxes, B, reduced maintenance costs, C, income instability turning debt into a threat, and D, faster transaction times. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. When income becomes unstable, the mortgage can turn into a significant burden, especially during economic downturns. This is the core of the leverage paradox. Now, to strengthen your mental model further, let's view a high-level mind map of safety, growth, and leverage. This mind map places safety, growth, and leverage as the 3 core branches. Under safety, we include the emergency fund, fixed deposits, and liquidity, while acknowledging inflation erosion. Under growth, we highlight equity mutual funds, the power of compounding, acceptance of volatility, and the importance of a 5 to 10+ year horizon. Under leverage, we place real estate, along with debt-to-income constraints, cash flow risk, maintenance costs, and illiquidity. The central message is that fear-driven decisions can stagnate wealth, while prudent diversification balances the 3 pillars. With the model clear, let's lock in the key points. Here are the key takeaways. First, right-size liquidity rather than over-prioritizing it. Second, use fixed deposits primarily for emergency needs. Third, lean on equity mutual funds to power long-term growth. Fourth, approach real estate leverage cautiously with clear cash flow planning. Fifth, diversify across buckets, define your goals, and commit to appropriate time horizons. Next, let's summarize the entire discussion in a few lines. In summary, safety is prudent, but excessive fear is expensive. Split capital into clear buckets for emergency and growth, leaning on equity mutual funds for long-term compounding. Consider property only when leverage is conservative and income is stable. Above all, stay invested through cycles to let compounding work while managing risk with time horizons and diversification. Finally, let's close the video. Thank you for watching. If you found this useful, please like the video, share it with someone who needs it, and subscribe for more practical investing guides. I would love to hear your approach in the comments. Are you leaning safety first, growth first, or balanced? Tell us your plan and why. See you in the next video.